Okay, good morning, ladies and gentlemen. This is Clueless Day Trading Frank. This is a free introductory webinar for the Clueless Day Trading chart analysis, as well as some helpful pointers on site navigation and the overall picture on my service. Session is being recorded, will be posted on the Clueless Day Trading YouTube channel. Highly recommended that all of you go ahead and make sure that your emails are there. You subscribe to that channel, so anything that I put out there will be directly you'll be directly notified via email. Full disclosure: this is purely for financial education and not for any solicitation or advice. Saying all that, good morning. Thanks for making the time to come in. We'll spend the next hour in a very constructive fashion, going over bits of several things instead of getting into one thing on a very in-depth basis. That's left for the advanced coaching sessions that are held on Sunday evenings, and we'll just join, so that's great. And I believe that Liz, you're already in, and Jules, I can't remember the top of my head, but if you're not, certainly sign up for them, because they are going to be extremely critical going forward, and not just for now, but for your own benefit, down the road. I have an ulterior motive for people to join the advanced coaching sessions. Those things don't make me rich, but what they do make me is make my life easier, because during this constant battle, what we call trading, my information and content that I'm delivering to all of you is better understood, and that makes my life easier because I have to answer less questions on the basic semantics of how these or the charts and the correlation between the indicators and things like that, because they're covered very intensively and in depth on the advanced sessions. More importantly, the background on the markets, which have a lot to do with macro global economics and the correlation between rates and currencies and oil and everything, which don't always flow in a seamless fashion. We all know as traders that it's not 1 + 1 = 2 when it comes to stock markets. But because I go into those stuff in detail and explain the background and the basis behind those economic correlations, people feel a little bit more comfortable when they manage their trades better, because that's really what it comes down to when they see turbulent times in the market, both on the upside and the downside. So that's why those ACS sessions are important. It makes my life easier. It certainly helps everybody who's taken it, and do feel, I keep the rates really low and stuff, so it's not like it's going to break anyone's bank. Saying all that, oh yeah, Jules, you did. Yeah, thanks for the reminder. So, okay, so what we're going to do today is go over the basic tenets of what the things that I do. Number one, I'm basically a quant chartist. I have a big background in my career. In fact, I started off as an analyst all the way back when the dinosaurs roamed. I'm just kidding. In the first part of the 90s at Putnam Investments, and I started working with some of I was just like any other kids out of college. It was a fantastic experience. I was parking I learned a lot. I parked my boss's car, down the docks in Boston, got him coffee, stuff like that, which are really big ingredients for becoming a top-notch trader. But more importantly, I managed to see the dynamics, and at that time I really didn't understand that much. I did have a very strong passion for finance and stuff, so that helped me pick up a lot of things. But I managed to see how all these big shots, how they manage different types of asset classes. I started working in the fixed income bond fund, which was at that time one of the largest. It was called the High Income Government Bond Fund, which was the PIMCO of that time, run by a gentleman by the name of Bill Landis. And then worked through the different departments on the equity side, their international stock funds, domestic stock funds, et cetera, et cetera. So what it did over the years, and then I came down to Wall Street in the mid-90s, actually latter part of the 90s, joined one of the bigger firms, and there began the quest to find the truth, right? Still looking for it. So the point is that all these, what I try to do with my service is not to make somebody a let's put it this way. My goal is not to, this is not your other typical services which are promising you, riches and wealth and happiness, and making, take a $5,000 trading account and make it into $5 million. That's not my goal. My goal is to basically share as much as possible what I'm doing on my side, and more importantly, give people a foothold in these type of extremely, as you know what I'm going to say, computer-driven, algorithmic, high-frequency trading, black box markets, which are no longer dominated by humans. Now, they are dominated by humans in the sense that those black boxes are programmed by humans, right? And as I'm talking, I'm just going to, sweep through a couple of these, simple charts. In fact, I'm going to go in and this is the one that I use most of the time. Okay. And so what happens is they are AI machines, they're artificial intelligence machines. They learn very quickly from their, from their actions. And as humans, they absorb, but the fundamental difference, they move very fast. We all know that. Now, it's not always nice, and it's not always fair, because in my opinion, the movements in the market, the overall manipulation of the market, in the old days, it was humans manipulating the market, the big shots, the barons, controlling the market. Then came the floor makers in the New York Stock Exchange, basically deciding what prices will be put where. Not an arbitrary basis, but still. And now it's the machines. So it's always been unfair. And it pisses the crap out of me because it's always unfair. But you know what? We can't change. Life is unfair. We all know that, okay? You got to fight for it. You got to grab it. You got to do the right thing. And, that's basically it. So through all this unfair manipulation of the stock markets, in my opinion, we still survive. And what I'm trying to do with this service is basically shed a different type of light on the markets, which will help people understand the new normal. They talk about the new normal, right? A word that was coined like 2-3 years ago. But this is the new normal that we live in. Fast movements, 5 minutes, what would normally happen in 5 weeks. They're happening literally, I'm not kidding, in an hour, in 15 minutes. So when I'm talking about resets, one of my favorite terms, but a real term, okay, and is these technical resets that need to happen in the market. On a psychological front, they're basically where the market is pricking the bubble in some cases, from overbought conditions to oversold conditions. Okay, from a psychological standpoint, it's profit taking, panic, fear, everything put together. Oh my God, is this it? As if large positions are put, there, and you just see the blood red on the P&L, like bang, the bigger accounts, thousands of dollars in minutes, just, not disappearing, just showing up on the P&L, Believe me, I've been there. I still go there. And it's not a good feeling. But at the same time, it's a mechanical situation. It's a mechanical market. So those things should not be feared. Does it feel good? Nope. Are they supposed to be panic and fear and oh my God, this is it, that's it? Nope. So my goal is to basically show all the levels as much as possible, because keep in mind, finish the sentence, as much as possible so all of you can effectively manage your trades. Okay? There is no perfect management. There is effective management of trades, but there is no perfect management. Like, oh my God, I sold exactly at the top, I bought exactly at the bottom. I've actually bought exactly at the bottom, but I've never, ever sold exactly at the top, because that, in my opinion, would be stupid, because I don't know where the top is going to be. Did I know that after Brexit, which was right here, we all tend to forget that we were going to run up to 2,200. Yes, I showed the probabilities of that happening, and that's one of my strengths, as you all know, and that's why you're here, and I thank you all. And did I show the probability that might happen? Absolutely. Did I explain the reasons of what was going on? Absolutely. Because that's another thing about my service. You're not going to hear a lot of BS and fluff. I try to say it the way I see it. I could be wrong on my explanations, but I highly doubt I am. Because there's a lot of hidden secrets about the market that nobody's going to talk about. Okay? The reasons why something happens for a technical basis, like I explained repeatedly on Friday, right? That it's basically what we saw on the equity side of the market was the direct result of the bond bubble pricking. It's not bursting, but it's pricking. In other words, all these billions and trillions of dollars sitting in fixed income, specifically government bond funds, all of a sudden had a panic attack. Right? Oh my God, yields are up almost 3.5%, not in real terms. In real terms, the 10-year bond yield, as I showed in one very important chart, saying the reason for the sell-off, and I'm sure all of you guys saw it, just ran up to 1.672%. All this stuff, by the way, I will be covering on Sunday night. I'm just giving you a rough idea, because there are some very important things that we need to know before we enter the markets on Monday. So we're well prepared. So basically, they were only up in net terms, a little more than 0.5%. But remember one thing, 0.5% on what do you call 0.5% on something which is trading at, I'll give you an example point. Just give me a second, because it's all about numbers and how you configure numbers in your head. And over time, and you guys, look, Will is very new, and his enthusiasm for learning is very high. Jules and Lizzie, I've spoken to you both, and it's been my pleasure directly on the phone, and as I do with all my new members and free trial subscribers. So basically, bear with me one second. So you've been trading for a while, so you've seen a lot of different things in the market. My service is just offering a different, not a very different outlook, but kind of an alternative outlook to several things, and which you're using with your other skills. So it's all good. Now the bond, I think I posted that out there, they were up about 4%. In other words, the yield went up by about 4% on a net basis, but the actual yield was only 1.672%. That's a 10-year bond. Now, with the 10-year bond this happened on Friday, okay? The 10-year bond moving up so fast, so furious, and it's happened before. It happened here too, okay? When do you think this happened? This happened back just in August. And you'll notice that every time bond deals shoot up like that in a big way, like it happened here back in July, that was during, this was the collapse in the bond deal during Brexit, that it is all of a sudden there's a rate tantrum. Okay, it's not a taper tantrum like we had in October of 2015. It seems like such a long time ago, when the Fed basically decided that no more, QE, which was one of the best things they did. Now they're deciding that, they're going to raise rates, which is, I think, good. But there's a lot of money sitting in this government bond complex. This is not a chart of the government bond. This is a chart, as I've repeatedly said, on the Treasury yield, interest rates, okay? So when interest rates sharply rise like that, all of a sudden, what do you think happens to the prices? The prices collapse. The prices on government bonds probably collapse. I don't have that figure right in front of me. Probably collapse anywhere from 5 to 6%, real fast. So what do you think happens? If, imagine Priceline, which we have seen before, okay, collapsing 5%, you're looking at a number of $133. We think the world is ending, then no one's flying. It's over, right? So in the government bond complex, even a single-digit percentage move down causes shivers and causes big-time institutional margin calls, panic selling. Everyone, even in all asset classes, people have, they have stops. Stops are triggered. It falls over on the other side in the case of the stocks, and that's what we get this nice, fat sell-offs. Always the same time, always the same structure, just for different reasons. I coined the term a long time ago in my first couple of years on Wall Street, and I explained to my clients, who are institutional clients as well as high net worth retail clients, was every crisis in life and in the markets is always the same for different reasons. And I think we can all relate to that, right? So without deviating too much from the point, let's go into understanding some basics of chart structure, the way I the way I do it, and things that you guys have to look immediately I should train into. Now remember, I use multiple platforms. My primary platform is or four. One is Thinkorswim, right? Thinkorswim. Dynamic platform, dynamic, fantastic for active traders, just like TradeStation and stuff. And I always suggest, and you have to have at least one platform that mimics one of mine. So in other words, whatever you're using, just have one that matches some of the charts that I'm putting across. So I use Thinkorswim. I use good old investing.com, which is very easy on the eyes, very dynamic. It's free. It doesn't have all the real-time data, but gives you enough to work on. I use freestockcharts.com specifically for more longer-term chart analysis and chart setups, because they're also quite easy to see and understand. And I use my ultimate powerhouse, which is the quad platform. I call it the Algo HFT charts. For more advanced traders, when they're ready, feel free to sign up for that thing, because it's just fantastic. Now, let me get one of that quad type of charts in here. I do not, on this particular terminal that I'm working on, I do not have the quad platform set. So I do apologize. I have that set on my other computer, and I have had extensive sessions on the quad side, which are available on the YouTube channel. You guys can review it. It's also on the website in the members area. And here is a picture of the quad. And if anyone is interested, we go ahead and send the link. They can talk to the company directly. It costs about $120 a month, and it's really worth the money, in my opinion. I've been using it for almost 12 years now, more so now than ever. So here's a picture of the quad charts, and those, as you can see, look a little bit different. Not only do they look different, they actually act differently, as in how quickly they're transmitting the movements in the market to me to do that. So I rely on them quite a bit. Here is Friday, 1, 2, 3, 4, 5, unheard of, but I love it. I mean, seriously, it didn't feel good, but I love it. The 5 candle move, which, by the way, this was posted, what time? I'm trying to find the time here. It was posted in the afternoon. I believe we sliced through that level. And this is another quad chart, for example. Oh, this is a much clearer one. On the SPX, right? And we're getting there. We're almost there. We lost at 21.37. We were down at, like, I think 21.29. We're getting here. That's first thing. It's going to happen. We'll cover all that on Sunday evening. So so let me get straight into this here. All right, we'll start off with this chart for basic chart analysis. Now, one of the most important things about charts is understanding patterns. That's the key thing. I am not, I repeat, I am not like one of the hardcore technical analysts that you guys find out there in StockTwits or other forums. Okay, those guys, some of those guys are rocket scientists. I don't even understand their charts, honestly. And they do all kinds of heavy-duty stuff. They do wave analysis and this and that, and it's just like, wow. And God bless them, because it works. To me, simplicity works. Simplicity with some complexity built in. It can't be that simple that, okay, here's a line, it's going up or down. It doesn't work like that, right? We know that. Just look at the volatility in this as we crashed and then rose to the skies, and now we're having a mini crash, right? But but I like to keep it within reason where I can, where I can actually explain it to somebody else like yourself. So the key thing about one of that is patterns. There's tons and tons of information on patterns in Google, in YouTube, right? And I just picked up one just to show you guys, just to go over a couple of quick things. So pattern recognition is key. Now, to me, it's over practice, and some people are better at it than others. I look at pattern symmetry. I look at pattern recognition. I look at the structure of what is going on, and it just comes kind of naturally. Am I right all the time? Absolutely not. But I'm less wrong than I'm right when it comes to the pattern recognition part. So saying all that, spend time on your own, just trying to understand the patterns. Tons of sites out there which allow you to do that. So simple patterns which are extremely important. Let me just message somebody who's trying to call me. Said, can I call you later? I'm hanging out with my favorite people, Jules, Lizzie, and Will. So there you go. So can everyone hear me right? I hope I'm not speaking into an empty audience. Liz, Jules, Will?
I hear you. Hear you good.
Okay, fantastic, guys. Fantastic. Thank you for being here. Okay, so this is my nice Saturday self. I'm just kidding. I'm basically a real nice guy. I get tough once in a while, but it's all important. It's all important because I'm trying to motivate myself. I'm trying to coach myself. I share that with you guys. So sometimes, we get into this. That's what trading is all about, having a thick skin, moving on, learning, taking the blows, standing up, and just fighting, That's just the way it is, and you get there. So saying all that, these are the patterns. These are some of the most commonly used patterns, even though he calls it the Forex chart patterns. It's, these are the patterns which we see all the time. Inverse head and shoulder, very simple. It's basically, you see that right there, left shoulder, right shoulder, head, show it all the time. Very powerful pattern. Can manifest itself in the middle of the worst markets ever. And there, like I've shown like I talked about in one of my, I think the last, one of the video casts or webinars that I did, ACS webinar, I think I did last week, and there could be multiple, there could be an inverse head and shoulder, which is bullish, and will, in your case, specifically, definitively go through the pattern thing. I'll find some really good links where all of them are laid out in one go. I know surinotes.com is one of them, but it's very, very critical that when I'm calling something a falling wedge or a symmetrical triangle or a inverse head and shoulders or a bull flag, that you guys all say, okay, at least I know the pattern and he's drawn it on the chart. At least you'll have an idea. To me, it's critical. It's not just, a chart really means nothing unless you draw over it, unless you structure it for your own benefit. So an inverse head and shoulders, very clearly bullish, right? Head, left shoulder, right shoulder. People freak out if they don't understand technicals, like, oh my God, we're starting to go up and then we're coming down. Here's your neckline. Once you break the neckline, it's off to the races. Now, why do patterns, what are patterns? Stock patterns. Stock patterns are nothing but a manifestation of human behavior. Yes, you all agree with me?
Yes, I agree.
Exactly. So it's so that's what it is. So if somebody says, no problem, Jules, I'll be putting this up on YouTube. Jules had to run. So so the bottom line is you got head, left shoulder, right shoulder. Now people say, well, what happens here? Why did this happen? Well, what happened here is some major shorts said, you know what? I shorted it here. It went up against me. I didn't sell. I shorted more here, and then it's just going. So you get a massive short squeeze. You have new buyers come in who say, hey, I'm at that breakout level, which is the neckline. I'm going to get in there. And then, so it's a confluence of short sellers, which are always the first ones to cover in the market. In other words, they're the first buyers because they're taking their profits. Let's not forget, what are shorts? It's just the inverse of a long. Stock, if you buy stock at 4, I know I'm explaining the basics, but this other people will hear it too. So as you buy a stock at 4, it's at 8. You got up 100%. And you take profit, you sell. So you buy low, you sell high. Shorts do the opposite. All right? They sell high and they buy low. So flip the coin around. They'll sell short at 8. So, and they'll cover at 4. What does cover means? They buy back at 4. What's their spread? They've just made 4 points because they had sold at 8. They had sold at 8 and so it's a basic assumption, and a lot of people tend to forget that short sellers have to take profits too. Can you mute your mic, Will? So bottom line is short sellers, simple things, but powerful things that can make you a lot of money. So short sellers have to take profit. That's why nothing goes down in a straight line. Bingo. Nothing goes down in a straight line, regardless of whether or not it's a cataclysmic event. Even then, you get reflex bounces. Yes, the term you heard a lot. Now, what are reflex bounces? They're basically shorts covering, some longs getting in, and making some tactical trades to make money. Those reflex bounces can be extremely powerful. We saw that after Brexit. So powerful to the point that a majority of people could not believe that we were up 1,200 points in 3 days. That's key, all right? So you got the inverse head and shoulders bullish. Then you got the head and shoulders everyone knows about. It's like that, what's that? Do they still make that shampoo, Head and Shoulders? And head and shoulders, terrible, which is basically you got the head, you got the left shoulder, right shoulder. Here's a neckline and a breakdown below the neckline would connotate. We had head and shoulders that developed really quickly in the market. And a neckline breakdown falls. This is also known as a dragon bullish. These are very basic patterns. Now, of course, in the market, it's not as beautifully symmetrical. You know, one shoulder's lopsided. I've shown complex head and shoulders where there's multiple left shoulders, all kinds of good stuff, you know, and then bang, it works out. So the double, so this is basically a double bottom. You see that in many stocks and in the market. We saw that right after Brexit. We saw that after every major drop in the market. All right, you go up. There is right at this somewhere, you know, somebody says, well, how do we know that's the neckline? If something's, you know, let's say imagine that there's a plunge here. You don't know where this is going to go. Well, that's getting into advanced technical analysis. You can use Fibonacci retracements. You can use prior levels, all kinds of stuff. Fib retracements work very well. So this is probably a 23.2 or 30 plus Fib retracement, not or even this is actually a Fib. Maybe now this probably is a 50 Fib retracement. What does that mean? I use that term a lot. It means that something falls hard, it'll drop, try to recover 50% of its value, and it works a lot. Okay, I didn't make these things up. Ask Mr. Fibonacci. You know, he's way gone. He's a great mathematician. So the thing is that this is a 50% Fibonacci retracement. You get back 50% of this big drop, roughly. And you can transplant the Fibonacci's on top of any charts that you're doing, especially on a plunge situation. So then, and so right there, they're sellers. Comes down, double bottom, you know what goes on. Very, very powerful patterns. Very powerful. Do not ignore this, okay, when you start to see it. The problem is, because of the volatility in the market, it's never that symmetrical. Even though when you look back at something in hindsight, like they say, the eternal truth, in hindsight, everything's 20/20. But that's what learning's all about, to study the past and try to see if it's replicating the, you know, in the future. Double top, the same story. It's basically an M. You have a neckline, you have a double top, a breakdown. Triple bottom. Gotta love these. We play triple bottom plays on our side. I've shown triple bottom on most recently on Chipotle. Now, I didn't buy Chipotle that day when Jules reminded me, and I was always tracking Chipotle, but then I put it out there, said, look at this. And the next day, the stock's up $26. Of course, we didn't know that Ackman was going to take a 10% position in the company. But I'm just saying, from a standpoint of other, I was still expecting. We had 4, 5, 6, 7, 8, 9 points. Triple bottom is very important. And when this thing is forming a bottom, it's never fun. Just remember that. So you don't always have to get into the first bottom, but then let me ask a simple question. Like almost very straightforward, cut out all the fluff. How do you know that this was going to be a triple bottom? It could just be a single bottom and a V-shaped move. Yes? Do you understand that part, Will?
I think so.
In other words, imagine that there is nothing, imagine that this doesn't exist. We never know what's going to happen in the future, correct?
Correct, okay.
Exactly.
Yeah,
so what I'm saying is that if somebody does not scaling in meaning putting little bits of it, or at least having a token position on a major reversal, okay, then how would you know that this is not going to go like this, and that it's going to basically do this? In other words, this dotted line here, this does not exist till the second top, correct?
Correct.
Right. So in other words, this line here is not, we cannot construct this line unless we get the second top. Because then we can construct the line by joining 1 and 2 reference points. You get it?
Yeah, I do.
There you go. So that's what I meant. That we don't know. So because we don't know, we have to rely very heavily on internals. That's the reason why these ACS sessions are so critical. We have to rely on the internals, which will give us a better probability of understanding whether this is going to be a triple bottom or a single V-shaped recovery. We've seen V-shaped recoveries that 99.999% of traders have missed out on stocks as well as things because they happen so fast, especially now because of the machines. We know that. All right, so this is the triple top. Triple top is kind of deadly if you ask me, because that means it's going to come down and it's going to come down. This very powerful pattern, the ascending triangle. Ascending triangle simply is this. I've shown this many times too. In other words, you start to get movements in the prices which are moving like this, and then they break out. Let me remind people, they also break down. Because at this point, the range is so tight that lesser and lesser players are getting in it. It's thinning out. Here is where the maximum amount of participants, stock market participants in the form of traders and investors are in. And as it's climbing higher, the range is getting tighter. This is also known as anytime you hear the word pinched, whether it's a pinched Bollinger or a very tight Darvas box, what we call a bottleneck. So imagine a bottle, and then it just goes like this, right? When you see a bottleneck on a stock or a market, there's a big move coming. You don't know whether it's up or down. And regardless of how much we analyze the internals, it's tough to tell what is going to happen when a bottleneck is formed. So this is kind of a bottleneck, except it's in triangular form. The Bollinger Bands, which are wavy actually, are also, when they say pinch, when I show things, I call it a pinched Bollinger. It means all of a sudden the Bollingers just basically just go like this. It's getting really pinched. We had a pinch Bollinger with all the wrong, which was giving all the false internal signals right before Friday, by the way. And if you look through my charts, you'll see that. I actually look pretty good to break out on the upside. But that's a different day story, okay? That's when you go into advanced stuff as to why certain things happen. Is there a way of telling? Not really, but there are signals. And then the Darvas box, which is basically used to look at ranges. They're all kind of range trading. So this ascending triangle is good because the upper end of the ascending triangle right here, when it breaks out, it breaks out. I showed ascending triangles prior to the August breakout on the stock market and made very well with that. On the overall SPX, ascending triangle. I just recently also drew an ascending triangle, which I believe can work out for the Russell 2000. It worked out the previous 3 times, and it breaks out. Descending triangle is just the opposite. the price range gets lower and lower, but the difference is that this particular time, this is a downtrend line. That's a downtrend line. See that line? That's a downtrend line. Keeps on acting as a brick wall. When you see a downtrend line acting as a brick wall and an uptrend, in this case, the uptrend line is acting as support, correct? You guys understand that, right? It's simple stuff. So the uptrend line is acting as support. It's a good thing. In other words, it's just higher lows, higher lows. This is basically the reverse of that, where the downtrend line constantly keeps on acting as a wall, resistance, and then it breaks down. Symmetrical triangle, it's basically, I've also shown this, where you basically have higher lows and slightly lower highs till it breaks out. This one. Symmetrical triangle, bearish is this one, right? The downtrend line always keeps on acting as a major resistance. It just can't break out of that downtrend. That means every time you go here, people are like, okay, it hit the downtrend line, I'm selling. So those are basic chart patterns which are important, which are critical. And I'll you on your own, I'll actually find some I'll find some sites which have all of them at one place. I'm trying to show you one more. Okay, here's one more which is extremely important. I've shown this one too. One of the best sites is, as you always should bookmark it, is Investopedia, right? Investopedia is, so I'm going to drag that over. It's the Wikipedia of encyclopedia of anything to do with investing. Bear with me one second. All right. Showing you, to explain to you what it looks like. You can bookmark this site, you know, on your screen. Triangles, Western, you know, this is actually a good one. I'll save this one as. And the one what I wanted to show was the falling wedge. You've seen me talk about this a lot. Falling wedge patterns, to the person who is clueless about technical analysis, like, what? The thing is just falling. Why are you saying it's going to break out? Because that's just the way it happens. Now, in order to understand falling wedges, you also have to have a defined pattern. And you have to also look at the internals, whether the volume is drawing down, you know, what kind of crossovers are happening on the stochastic side, all that stuff. And falling wedges go bang, up. And they do tend to form over a longer period, usually 3 to 6 months. And the longer the falling wedge is, the better off the breakout will be. A rising wedge is the same story, where it's the opposite. It rises like this. And these are not, you know, people who don't quite understand technical analysis, you know, they have to obviously study and get to know them. This is a rising wedge, and then gets really quiet around here, and then it drops. Opposite of this. Then you have the cup, this one I want to show, the rounding bottom, okay? This is also known as a cup and handle. Now, what is a cup and handle? Extremely powerful pattern. Not seen as much as quickly because, like they said, the pattern is traditionally thought to last anywhere from several months to several years. The bigger the cup, it's going to be bigger the rise. Nowadays, because of the advent of machines, it doesn't take a couple of years. It takes a couple of months, if not a couple of weeks. In some cases, not a couple of days, a couple of weeks in the case of the cup and handle. Here's your cup. Here's your little consolidation handle. where profit takers come in and traders are like, oh my God, this thing's going down. It's just a simple consolidation channel and then a breakout. Within this cup and handle, which one I just kind of rounded it off, there are multiple patterns which are in place. As you get better and better at understanding the dynamics of technical charting and making real money off it instead of just looking at prices, then you will realize that you'll see all the different patterns take shape within the context of this. Here you had a triple bottom. You had a nice little bull flag. I mean, big time candle, a little consolidation, another huge candle, a little consolidation, then a monster candle. Obviously, you know, most of the times, you know, unfortunately, retail investors get around here, then they start getting slapped as this consolidates. They get out and they see the thing just take off like a rocket, and they just hate themselves over and over again. Like I say, the pain of regret is far worse than the pain of sacrifice. I didn't make that word up, okay? So the bottom line is, this is a very powerful pattern too. Now, Will asked me a question which applies to everybody, all right? Which is that entries are great, exits get to really messy. Well, that's because, not anyone's fault, but that's because exits are meant to be a couple of things. One, how your P&L's looking on the other side, how many actual dollars you're up. Number two, you have to keep on studying the charts to see whether or not it's a continuation pattern or whether or not it's just going to drop off next day. And number three is self-discipline method of taking some profits and leaving some on the table to run with the market, and not expecting that every single day, even on a big fat breakout of a stock or the market, that every single day is going to be an up day. That, I think, is the simplest way of explaining it. Everyone tries to time the market. I do. You all do. Everyone thinks that, oh, if I get in here, it's going to just move on from up here. It doesn't work like that. The biggest trades in your career, in your history, life that you'll make, that's going to make you feel like you're, you know, Superman, are the ones that's going to give you the most angst. I mean it. Yes, you know, multiple times I've shown things that are up 100%, 200%. That starts happening immediately. If it's even a 1 day late, I can sense it, and there's nothing wrong with it. I can sense it in the room. It's like, oh, this guy, you know, yeah, he's good, but I don't know what's going to happen. And then people sell. And look what happens within 48 hours. Case in point, Goldman Sachs from the 140s or even the 150s. Where's the stock now, even in this market? 170 some dollars? It's happened way too many times. So in order to defeat the deficiency of managing effective trades, you have to understand technical analysis, have to delve into this stuff, have to take these classes so I can share all these things, because every mistake that I've made, I try to share with everybody because I've learned from it. I'm a living example of it. So let my mistakes be your salvation. I mean, let's put it this way. So you don't have to make the same ones. But a lot of it has to do with mental discipline, and that's something you'll have to work on it, right? That's something I can't work on. So that's my whole point here. That so from a standpoint of effective trade management, you have, number one, you have to understand the technicals. You cannot be just looking at prices. Something can be, look, Goldman was a prime example. Stock went up $3 one day. Next day it was down about $1.50. I know a lot of people sold. I mean, this was from a couple of weeks ago. Short was looking fantastic. Same thing would happen with Allergan, 20 points lower. Same thing I've done with VRX. So every pattern is showing continuation pattern. And yet the prices are vacillating. They go up, and then they have a couple of red day. Maybe the red day continues on a second red day. But 5 days later, it's out there. So the bigger your trades are, of course, you want to take some profits off the table. But if it's a smaller trade, you want to stick with it. Over time, you will master that. No question about it. But you have to understand the science behind it. Okay. Now, let's take a quick, I'm going to go through the charts here because we don't want to spend the next 2 hours doing this. But like I said, I'm just giving you a basic flavor. So you have, this is obviously the most advanced charts, which is the bar charts, quad, algo HFT. When you look at this, the first thing that you do is you look to see, and this is a daily chart, so it's a little bit more wider, zooming out, right? First thing you see is stochastics. If you want, let's start off with the internals. The fast stochastics are just what it says. They're the fast stochastics. They tend to reset overbought here, oversold here. Simple. Same thing as RSI, relative strength index, right? The traders who just trade off the RSI. So what the stochastics is the first derivative of the RSI with a couple more variables in it. So you see, you get into overbought territory. There's no guarantee that it's going to just plunge like that, like it did on Friday. I like it. It plunged fast. The faster it plunges in the midst of a market capitulation, the faster it's going to have a retracement bounce. What happens after the retracement bounce? That takes skill to understand, and I'll be there to provide whatever I can of my skills and expertise. That dead cat bounce, which will come within 48 to 72 hours, in my opinion, or earlier, will be vicious. I've said it every single time. I've been right 95% of the time. You got to catch it. Okay, so and when I say a bounce, doesn't mean it's going to just take back all 400 in one go. I'm talking 100-point bounce, possibly 150, whatever the case may be. We'll deal with that on the Sunday night session. So stochastics, overbought, you start to, if I pinpointed the buys here and it went up, then you want to be sellers at this point. Now, just because stochastics go up here doesn't mean they're going to plunge like that. They can stay overbought. You can see that here, as you saw here. They can stay overbought in between a very tight trading range. Okay, very tight trading range. That was just back in June, right after Brexit. So you stayed overbought for weeks. That's your slow stochastics, right? Oh, so I'm sorry, here, fast stochastics, stayed overbought. A quick plunge down, things getting oversold. Remember, just because it got oversold doesn't mean it's going to do a V-shaped bounce into an overbought territory, which can happen. Happens all the time. Look what happened after Brexit. And this is looking very similar to Brexit. A little bit more down, and then you get a reversal bounce. I'll get all into this on Sunday. Remember the blue line. This was the multi-year breakout in the market. And I did say in my previous verticast from about 2 weeks ago that we are a good possibility in September. I thought it was going to be mid-September, actually. This is happening earlier. I never thought the market was going to come down like that on pre-9/11. Because I had real strong feelings about, I thought they would respect that event. I mean, except it was just a full-fledged, throw out the thing. So not good. No respect there. But saying all that, these we'll study on Sunday. So you had that complete V-shape. We have multiple V-shapes all the time. Big move. See that V-shaped move. Slow stochastics. Slow stochastics, when I'm posting it, is more for swing traders. Okay? So what is the slow stochastics telling us here? The easiest way to read it is that we are not down here yet, like we normally do. On the daily, the slow stochastics very seldom break below the 20 mark. In other words, this lower line. If it breaks below the 20 mark, you need to be heavy buyers of the market for obvious reasons. Because by that time, things are very deeply oversold. What does deeply oversold simple mean? Simple English. In simple English, the deep oversold will simply means that things are getting a little bit cheaper in the short term. And that's it. That's the point of maximum fear, just so you know that. So it's down here. So that's how you read this chart. The lines, the pivot lines, the green lines are resistance on the up, what the resistances are. The yellow line, this yellow line is the pivot. I'll get into the pivot stuff on Sunday evening in a big way. That's why I'm doing this intro session. The pivots are very important. Once you lose a pivot in a big way, That means the market's coming down. You obviously, this is an uptrend line. You see that. That's pretty clear to see. We broke the uptrend line. It's a clean break. But once you lose the pivot, the good news is that you actually bounce back, try to getting back that pivot wherever it is. Now remember, these are not static lines. They will automatically be adjusted this weekend. If I pull up this chart, I expect the pivot, which is the yellow line, to be probably like this right now. So the pivots come lower, and these red lines, which are the support lines, are probably down here right now. You understand that part, right?
Yep, I understand that.
Yeah, this, support, obviously, now that the prices are lower, supports are lower. This was from Friday. So let's get out of this here. So I'm going to just screen through some of the charts that I post. So this way, I'm trying to do this. Hold on. So that's your Algo HFT version. Now the other charts that I post throughout the day, this is a clean one to understand. Quick. Here's your breakout zone. I write it down. I don't like putting too many titles on the charts because then it gets too messed up. To me, all this makes sense. To a lot of people, if I wrote all over the charts, they'd be just like, it's too busy, they don't get it. But important things I'll put down. Breakout zone. This is your multi-year breakout zone on the market, that big fat green line. Here's your uptrend line. What is this pattern? I just covered it. Do you remember? This triangle? Remember, I just covered it a few minutes ago?
Yeah, that's the ascending triangle.
There you go, sir. Exactly. This is ascending triangle. This was your ascending triangle breakout back around right before. Remember what I said, don't ever short July 4th weekend. That's exactly what happened back there. That July 4th weekend. We basically broke out. So we broke out of it and we huddled around, and then now we're having a correction. When you look at this chart, it's actually pretty easy to understand because this ascending triangle, and then you had multiple patterns within it. This particular magenta thing is called the Darvas box. Now, what platform do you use, Will? It's very important.
I use Street Smart Edge through Charles Schwab.
Okay. I'm telling you now, and I'm telling you again, you really want to make money, you got to use Thinkorswim and then eventually move up to the more advanced platforms. Thinkorswim, you can literally open an account with $100. I don't know what, I've been saying this for a long time. If you don't have the right tools to navigate these markets, it's going to be impossible for you. I don't know what Charles Schwab Street Smart is. I'm sure it's a good trading product. Does it look anything like this?
I mean, it does a little bit, but it's not as technical. It doesn't have the Bollinger Bands or Stokes.
High time you moved up to the next level, okay? Because you want to, you stepped up now to the next stage. Well, I was wanting you to do that. I'm proud of you. You need to do that. Open up a Thinkorswim account, $100. I've said this many times. I had a Thinkorswim account a couple of years ago. I didn't use it for 2 years. I just used it for charting. And it's not just fun. It puts money in your pocket. That's what it's all about, right?
Yep.
You need to do that.
Is it a one-time fee?
Yeah, like opening. Yeah, there are no monthly fees or anything. No. Okay. Go to Thinkorswim. I mean, unless they've changed the rules. I mean, I use it exclusively. But the thing is, open a proper account, okay, and then just yeah, they don't charge you a monthly fee. But then all of a sudden you have access to everything. You have access to the tools, the weapons that you need in battle, because that's what we're really doing, right? So yes, you need to have that ASAP. And everybody who's going to listen to this, remember that. So anyway, so you have the uptrend line ascending and this and that. So when I'm posting these charts, look at the lines that I'm drawing on top of the charts. Look at the moving averages. I use the 34 and the 50, not exclusively, but extensively. 34 and the 50-day moving averages. And then I put the Darvas box over it. Now, what's so important about the Darvas box? Well, the Darvas box is important because it gives me a range of when I can sell and when I can buy among the multiple indicators that I use. But if somebody was trading right off the Darvas box, especially active trading, you win a lot because the Darvas box is not controlled by me. It's an algorithm written within the Thinkorswim. And by the way, Thinkorswim is the most advanced algorithmic indicators that's out there. So all these indicators that you put for free on top of the charts, there you go. I'm not controlling the stochastics. I'm not dragging it down from overbought to oversold. The computers are doing it. They're telling me an idea whether or not I'm going to be making money off each of these turns from the lower level on the oversold conditions. Significant amounts of money have been made. I'm dead serious. This move alone in Brexit, a $4 S&P call went to 60 in 3 days. 4 to 60? If I give you a stock at 4 and 3 days later it was at 60, I mean, come on. That's what I'm talking about, is these indicators are simply early markers. This is telling me, and I'm going to get into that into ACH stuff, that we're not fully oversold yet. And we'll get there quickly by Monday morning. So you look at the stochastics. Stochastics down here, you start to basically place your buys. The histograms, the McLaren oscillator is another one that I use. Simple. When it's in deep red territory, this closed at minus 140. They didn't close at 140. I think this chart was put out there. What time? I don't have the time here. I don't think this was at the close. But anyway, the deeper you go into the red, it's not even in red right now, but the deeper you go into the negative level on the McLaren oscillator, like we did during Brexit, we went around here. We're almost there, just in 1 day alone. This was huge. This was the big crash of January 2016 that most people forget. A double bottom, and look at this move. You could retire on these type of moves if you catch them. I'm dead serious. All right? So you get this deep oversold, you want to plunk in and just sit there for a bunch of days, if not a week or two. Because this type of move, among many different indicators that went positive during that time, tells you to stick with the trade. So that answers the question. A good question that you asked me is, how do I manage my exits? That answers the first part of the question that you asked me. You got it? Entries from bottoms can be identified. It's a double bottom, you get in there. But then everybody sells after the first move and see the market climb higher another 300, 400, 500% on the options, and they're like, holy shit, I can't believe I did this again. Yes or no?
Yes.
It happens to me also sometimes, especially in fast markets. But it happens to other people all the time. And that's bad. Because your brain finally says to you, enough, stop being stupid. Leaving 600% on the table while making 40%, the simple excuse that a brain tells you is, oh, well, there's next time. There is no next time, because the next time you're going to do the same thing. If you don't understand the intricacies of technical analysis and the stuff that I teach. That's what I'm getting at. I'm not saying it's going to be the answer to your misery of selling early all the time. All I'm saying, it will help you have less misery on exiting positions based on many different indicators, but in simple terms, the stochastics on the daily. So that's how you read the Thinkorswim. The Darvas box gives you the range it's traveling in. Let me clean this out. Range it's traveling in. These are the lines of support. You have to understand the patterns. Obviously, this is the line of support down here. We're almost there, by the way. By the end of the day, we were down here, actually, almost here. When I said the markets will test the breakout zone at around 2125, possibly around, yeah, like between 2100, 2125. I'm just making this up in the top of my head. I'm looking at this chart and saying, okay, this is what happened every single time. Now, if we break the downtrend line, then obviously the Brexit lows come into play. And then a different pattern shapes up. Do I think this is going to happen in one single go? I don't think so. I think we'll find support in the zone before we bounce a bit. If we fail there, then it's possible that we hit the Brexit lows, which were around 2000 S&P. Remember that? You will remember.
I do.
Yeah, exactly. And that would be a powerful buying opportunity in my opinion. Markets very seldom, okay? And even here, in between, this seems like, okay, it was a one-way drop. It wasn't. There were multiple days here that the market was up here, in between, were up 100 points against a face of 200-point drops. So if this type of calamity happens where the market loses 800 points or so, then we are looking at the Brexit lows. Is it possible? Absolutely. But in between that, if you think you'll just basically, if you short something here and expect to make 5,000% on it, let's say, all right, which you could if somebody shorted here and covered here, then in order, and this is one of the final things I'll say, then in order to do that phenomenal trade that makes you feel like you're a Superman, you will need to swing it and close your eyes, not close your eyes. You got to swing it, stick with the discipline of what you're seeing here, that these stochastics, regardless of these green candles, each of these green candles will, and everyone else will be listening to this, are 50, 100 points reversal moves. So if you're short and you started to see a 60, 100 point reversal move on the markets, wouldn't you cover your shorts and panic, right? Like, oh my God, I'm short and now I'm going to lose all my profits if I don't take it. Yes or no?
Yes.
Exactly. However, if you follow the discipline of what was happening with the internals, you would know there was no turn.
Mm-hmm.
That's what I'm getting at. Shorting is the same game as longing a stock. It's difficult to hold profits on a short because the market's tendency is to jerk, is to have these reversal moves higher, correct?
Correct.
Right. So part of it is that if you want to have a core swing position that you, let's say you nailed the top, you said, man, I nailed the top, is to have a little bit still open while you're taking profits along the way. When we short something at 4, I remember I shorted Tesla once at 4, that thing went to 36. So I kept on selling. I mean, I first it went up to like 7. So I sold a bit. The charts, Tesla is a very dangerous stock to short, by the way, especially of these levels. So 7. Then it went to about 9. I'm like, okay, I'm taking a little bit more. I didn't know it was going to keep on dropping, but the internals kept on saying that it was going to drop. This was, and it all happened within 48 hours. This was a couple of weeks ago, and then it actually went to like, I think 22. I wasn't there at 22. I was well gone around 16 or 18, and I wanted to slap myself. I was there at 22, but I'm a disciplined trader. That's a pretty significant profits. From 4 to 16 is 300%. Yes, I missed the last 6 points. Maybe I should have left one of the contracts in there. But because the thing was falling and then having these big sharp moves up intraday and stuff, that's like, you know, but it really disciplined. I don't know who's 100% disciplined. I'm not. I'll be the first one to admit. Okay? The only people who are 100% disciplined are not humans, are machines. Machines can be programmed to execute a trade or fight a battle with precision mode without any feelings. Our biggest enemies are our emotions. Just the way you're growing your account, you know, early stages, I have to worry about protecting and growing my account on a larger level. So our feelings get us out of trades faster than we think. So saying all that, the internals do matter, and this type of heavy-duty move don't come around too often. And look what happened after that. That was a massive W formation, which is known as a dragon bullish. We just covered that. And after that, it continued higher. But in between that, we have had consolidation days, right? These consolidation days are also scary for people who got in on the top, because these are 200-300 point type of profit taking. Didn't change anything. So that's why where I come in and put out my charts and say upside is intact and all that stuff. All right, that's on the think or swim side. Then I do these ones, which are very easy to understand. And every new member who's going to be listening to this, please, you know, pay heed. These are easy to understand. You see the green candles and the red candles. I don't put too many indicators on these. Sometimes I do because I want to keep them simple. Here's your stochastics. Big, deep oversold. Doesn't matter. They kept on limping around because there was so much pressure on the market. So much pressure on the market. One quick thing I'll say, which I'll discuss in the lies in the media spreads. The media keeps on saying that all of a sudden we have volatility in the market. Didn't you hear that a couple of times on the news?
Yes.
Yeah. Oh, they came back and all of a sudden. I say, liars. We have had multiple volatility just by looking at this chart. This is August 24th. You're telling me this is not the face of volatility? So what lies are they spreading? You hear Santoli saying that. You hear all these other idiots saying that. They're lying, and they're lying for a purpose. The reason they're trying to fool the masses is because they think they make money off volatility. Who makes the most when markets are really turbulent? The commissions generated by trading, correct? Traders. So big brokerages, discount houses. So they're telling me there's no volatility? Well, let me show them this chart, and it pisses me off because they're such liars. There's been heavy volatility all the way through, and they're saying now the volatility is really going to rise. What are they talking about? Everyone lies to further their own gains. Just remember that. But I just wanted to highlight this because I kept on hearing it, and it just is such a blatant lie. But for the average person out there, they have no clue. They just eat those words up. Oh yeah, now the markets are all of a sudden being turbulent. Well, the market's been turbulent, and this is just a quick snapshot. Now, why do we know it? Because we're traders. I've been showing this all the way through. You think these big fat moves, which happen in an hour, in a couple of days, are not volatility? Yes, this was extreme volatility on the downside. What's there to cheer about? You know, these guys in the Chicago Mercantile Exchange and stuff, the ones who basically, you know, really have not been making any money, all of a sudden they're cheering volatility. Cheering volatility means that you're basically robbing mom and pop, who pension funds and their IRAs are getting hit huge, like they did on Friday, and you're cheering it. Wrong. Okay, the McClellan oscillator, very simple. Let me just get a better picture, and then we're going to wrap out. So that's another chart that I use. So bear with me 1 second. Then I use freestockcharts.com. All right, same thing. Look at the lines. Red lines are resistance. I'm sorry, support. Green lines are resistance. Downtrend lines, uptrend lines are drawn either in blue, green, sometimes white. These are support levels. The white lines drawn, or can signify the trading band something is moving in. Same thing with stochastics. I'll get into all these other indicators, you know, when you get into the ACS world. Okay, McClellan oscillator. So let's do a definition of what exactly is a McClellan oscillator, okay? So here's your McClellan oscillator, all right? That's the actual definition. Actual calculation of what a McClellan oscillator is. You don't want to get into it, but just, you know, if you want to get into it, you get into it. It basically is adjusting into account the changing totals and number of issues traded on the New York and NASDAQ. Instead of using the number of stocks that are advancing, calculates net advances as a percentage of advances per decline. Okay, so this is the formula that's used. Generally, what they look like is this. Okay, when McClellan oscillators go well below 100, that means things are getting really, really ugly, which means certain things are getting cheap. When McClellan oscillators go close to 100, okay, they basically mean things are getting overbought. And that's pretty much it. They are all based off moving averages. The formula is put out here, and this would be go to Investopedia and then type in McClellan oscillator. Go to stockcharts.com. You can basically, you know, if you really want to understand, you know, how net advances range. So it looks at the number of advancing issues, declining issues. Okay, and then looks at the and divides it uses a couple of different variables in the form of exponential moving averages. So McClellan-Oscillator, in simple terms, be a visual trader. You need to be a rocket scientist in this. Is when it gets deep red, things are very oversold. And when they start to go like this, that's the worry sign, because that means they're going to drop most of the times. And when they get well overbought, they're all the way up there. So in the case of I'll put a live chart out there. Hold on. So let's look at a stock, okay? So let's look at Facebook. And let's look at a shorter term version, 1 hour chart, all right? So on a 1 hour chart, the McClellan oscillator is like not only cliff diving, it's like jumping off Everest. Right here, okay, before, what do you call it? I'm just trying to find a peak. Okay, this is a good example. McClellan oscillator here on the right-hand side, what's the number? What's the number here?
289.
That's right, sir. So yeah, don't worry about it. Let's say 290. So at 290, here's your McClellan oscillator. Look, Facebook was overbought. Even though it looked like it was going to take off from this level, this was when the stock was at 123. I did, this was a chart that I did. It went above my forecast, which was more like 128, 130. It went up a little bit. Now it's getting cheaper again, which is good. So anyway, so right there, it got overbought. So right when it got overbought, if somebody was clearly tracking the McClellan oscillator and the stochastics, you would have seen it was overbought and it was overbought. So you wouldn't be chasing it at that point. You would be profit taking at that point. A lot of people who have, majority of traders who don't follow technical analysis, they'll be chasing it at that point. And guess what happened? The stock dropped a good solid 3 points. McClellan oscillator went into oversold territory, which was around minus 200, right? Minus 200, generally speaking, is good enough entry point into a stock. Look what the thing did. Make this bigger. Let me show you this part quickly. Let's get these out. Okay, now it's clearer, right? You can see things. Let me make this a little bit smaller for the lack of space. Here's the inflection points. McClellan oscillator here, overbought, stock overbought. Oscillator going flat to sideways, stock is going flat to sideways. It's not, remember, nothing is a perfect science, but I'm giving you a basic idea. Here, McClellan oscillator was very overbought, but the stock basically at that point had shot up big time. It went from, it was just the other day actually, right? It was last week when the stock was up like $3.50 all the way from 126 to 129. Because it's a shorter term view, you're going to see some correlations which are not exact. Do you understand that part?
Yep, makes sense.
Yeah, McClellan oscillators tend to be extremely powerful indicators over longer terms. In other words, 4-hour charts, daily charts, weekly charts. In a weekly chart, if I see a McClellan oscillator down at minus 600, which never happens, by the way, just so you know, I think the most it got to, the McClellan oscillators are amplified when the time frame is shorter. You understand that part, right?
Yes.
Yes. So in a 1 hour, minus 600 is good enough for me to go in there and buy a crap load of Facebook cheap calls, because minus 600 is an extreme level. Does it guarantee a move higher? There are no guarantees in trading, but it does guarantee some sort of
a good chance that it's going up.
The key word to use, that the probability is quite high that it will not just go up, have a snap bounce. Now the snap bounce will happen because whoever was short the stock on this double barrel bearish engulfing, that's called the bearish engulfing, okay, candle, we'll talk about that in the ACA sessions, at 131 said, whoa, I just made myself 5 points. You get it? So they made 5 points from here to here, the shorts. So you don't think they're going to take the 5 points and run? Well, they'll take part of it. So when they take the 5 points, they're going to cover. That means they're going to buy, and the stock could very easily move up possibly towards these moving averages. You learn all that stuff, okay? And that could be a 3-point move from nowhere, where it fails again if it wants to go down. In the meantime, that's the answer to a McClellan oscillator. Gets really deep oversold. It's time to really, and it'll correlate with a sharp movement in stock prices. Now, the same McClellan oscillator looked on a daily, like I just explained, is not showing you minus 600. It's showing you a level of minus 150. Here's the quick rule of the thumb before we wrap up this intro session, is when you're looking at these type of indicators, whether it be the what do you call it, when I'm drawing the charts, this is a daily chart. This is your stochastics, fast. It's telling you it's not over yet because it hasn't come down here. Can it turn from midway? Absolutely. Now this is the daily swing. What you do is you look for previous reference point. Just the way in life, we'll always look to see, okay, when was the last time I did this or did that? Do I remember how I did it? So the bottom line is when you look at previous reference point, very simple. Here we are at minus 147. This was Brexit. Remember, Brexit was right there in mid-June during my birthday. So it's like there was Brexit. Where were we? We were pretty much at that same level, a little bit lower. So you start telling your brain, okay, when we got every time the McClellan oscillator got to this horrendous level, which is 150 to minus 150 to minus 200 on the daily, it seems to be a buying opportunity. It was. So those are things. Now, it doesn't mean because of the pressure of the buying, the momentum is very much on the downside right now. So unless we get down to some horrific levels, which will happen very fast, very quick on Monday, maybe I'm wrong. Maybe we'll open up like, 40 S&P points. I have no idea, but we'll talk about it on the advanced coaching sessions tomorrow evening. So that's how you read the McClellan oscillators. All right. So to wrap it up, this is just an intro on things that on the chart analysis side, there is so much. This is a craft that can be developed over, it takes years to develop. But when somebody takes the time and the energy, like I do, to go over this advanced stuff and explain it in a simple fashion, I believe, which I've seen in real life with a bunch of my members, that not only do they benefit, they actually manage their own trades and do their own trades at levels which I am thoroughly impressed with, using the same sort of tools that I explained. So on that note, Will, I'm going to step out, going to do some family stuff on the weekend. See you all tomorrow evening, or Sunday evening, sometime
7 p.m.
I would say 8 p.m. Eastern time, because you're 1 hour behind, you're 1 hour behind me, right?
Yeah, 7 p.m. for me.
Yeah, I like doing 8 because that also gives time for the West Coast members to join in. They don't have to rush back home too fast. And keep an eye on the Twitter feed. For all members who are listening, my content is delivered primarily, exclusively through the @Clueless8RT, standing for real time Twitter feed. So anything that I'm putting out there, whether it be webinar timings, trade alerts, content on charts, breaking news, all that stuff is done there. I also put the same information not on the trade alert side, but if it's a reminder or a webinar update, also in the chat room. So those are the two conduits that you need to check in order to see when my sessions are and such. Thank you for listening. Thank you for all your support. I look forward to seeing you guys tomorrow evening. Thanks, Will.
Thanks, Frank. Very helpful. Appreciate it.
No problem. And this will be uploaded on the Clueless 8 YouTube channel. You can listen to it anytime. And as we get into the ACS sessions, those are private sessions, as you know, for paid students like yourself. So those will be available to you at any given time also. All right?
Yep. Thanks, Frank.
Anytime.
See you tomorrow.
Bye-bye. Enjoy.